Tuesday, June 9th, 2020, Monaco 64, home of alternative economics and contrarian views. Today I want to talk about how government bonds, U.S. Treasuries, they're all IOU Nothings, and I'm going to reference an article by John Exter back in June 1972 for the American Institute for Economic Research. Before that, I want to talk about a few things and quickly look at the markets. Today we'll go last for the main topic. First thing I would say, an analogy to explain what's really going on, in my opinion, with the economies all around the world today. So I'm going to take, for example, a family, a big family, a family with maybe 6 children, some of them working, some still at home, some still at university, and the parents, let's say both parents work, have good jobs, but they live way beyond their means. They've got a Big Mac mansion, they've got a huge mortgage, they have 4 cars, all on finance, and then all of a sudden disaster strikes, and some of the children lose their jobs. The parents lose their jobs as well. Their investments go down the drain. So what do? Well, they go to grandma and grandpa who have been frugal and they ask for a loan. Grandparents, of course, are worried, so they give them the loans to the parents and the children, the grandchildren, expecting them to pick up again. But they don't change their habits, but they keep lending to them. And I think that's what's happening in the world economy today. And it's even worse because I don't think the grandparents have any money. So, and the grandparents, by the grandparents, I mean the governments, the Federal Reserve, and so they have to go and extract that wealth from you, not only today through taxes, but in the future and for future generations. And I think that's what's going on. And that's what you need to keep in mind. They're not changing their habits. The governments are not changing their habits. People in general are not changing their habits. And I think it's called moral hazard, of course, because the Federal Reserve again has come to the rescue of mom and pop. And by mom and pop in this analogy, I mean the big corporations, Wall Street, City of London, the big international banks. I'm going to put a really good video by Wolf Street Report YouTube channel he did this weekend about how the Fed is bailed out the wealthy while the general public has been left holding the bag as usual. I'll put it down in the description and up in the cards. So that's one thing I wanted to talk about, how this economy is going nowhere very quickly. All the cheerleading reminds me of back in 2010-11 when they kept going on about the green shoots that the economy was going to recover. It's the same propaganda right now by the same people. They're losing control. You need to be careful not to be distracted by all the distractions. You know, the stock market distraction, that everything's fine. We're back to where we started the year. NASDAQ is making all-time highs. All the political distractions as well. Those are things that you need to put to the side and focus on yourself, your family, and making sure that you're self-sufficient, that you're out of the system as much as possible, that you eliminate debt as much as possible, and try not to deal with government. The other story, before I go to the IOU Nothings, is something I saw from John Adams in Australia. In his LinkedIn, he put a post. So it says the story: Victoria Police closed a Mornington Peninsula pier over fears people weren't strict social distancing just 2 days after thousands marched through Melbourne without penalty. So there you go. That's the world we live in right now. It's hard psychologically. I see things that make me quite annoyed and angry. I think the best thing when you get like that is to try to forget it and then realize that you're going to go to bed, you're going to have a nice night's sleep, and the next day things will be hopefully a little different. And the thing I would say right now is that back in the old Soviet Union, for example, the East versus West engineered Cold War as well, at least people in the East that lived under authoritarianism, they had some hope that they could leave one day and come to the West, which used to be free. It looks like now everywhere around the world there's no haven, and that's worrying. But anyway, quickly look at the markets. So this morning we've got gold is trading back above 1700 here as I speak. We're at 1702, up about $4. It's 8:38 a.m. London. Silver is at 1761. Silver's down though, about almost 1%. So silver underperforming here. We've got the Dow down 140 at 27,420. S&P down 20. So stock markets are down just over 0.5%. The currencies are down as well. Sterling is down 0.5% at 126.60. The euro is down 0.25% at 112.64. And I've noticed as well that the 10-year yield is down substantially this morning. I told you they couldn't let it go above 1%, and they can't. 10-year yield right now is at 0.83, down almost 6 basis points. So what about oil? WTI is down 1/3 at 38.25. I also recommend another article, or it's actually a newsletter written by Scott Minard from Guggenheim Asset Management, big Wall Street firm. He's a Davos guy. I think he was at Davos this year, but I think it's interesting to read what he thinks. I'm going to put a link below in the description to his June 8th newsletter that he writes to his investors, and he makes it public, which is good. It's called Global CIO Outlook, the Fed's Roadmap. A lot of the thing he says kind of correspond to what I actually said yesterday, which is a coincidence because I hadn't read what he said in his newsletter before I made my video yesterday, and you'll probably see what I mean. He even says at the end that the last resort for the Fed would be to actually start buying gold. So there you go. So I owe you nothing. Yeah, John Exter said that currencies today are I owe you nothings. And that was back in 1972, just after Nixon dropped gold convertibility from the Bretton Woods system. So that's why he wrote that. But I would say that government bonds are I owe you nothings as well, because all the currencies today, fiat currencies, are backed by government bonds. That's how they issue currency into the system. Federal Reserve will create their entries out of thin air, digital entries out of thin air, to buy government bonds, to buy corporate bonds now, to buy agency bonds. And when they do that, they credit the account of the institutions like the Treasury and banks from which they buy those bonds. They credit them with Federal Reserve notes or credit. It's not note yet. The Treasury, of course, can decide to have their account issued into the system through the Bureau of Engraving, right? So that's what it's backed by, basically, by the government bonds. It could be backed by stocks eventually, as Scott Minerd says. So who was John Exter? I've been reading about what he thinks, what he has said for many, many years. Back in the early 2000s, I started looking at John Exter. He's quite famous for his inverted pyramid, but today I want to look at the IOU Nothing. So John Exter was an American economist. Well, he was born in 1910, died in 2006, member of the Board of Governors of the United States Federal Reserve System. So he was a central banker, but he was kind of a black sheep, I would say, of central banking, and founder of the Central Bank of Sri Lanka. He's also known for creating Exter's Pyramid. Graduated from the College of Worcester. He then went to the Fletcher School of Law and Diplomacy in 1939 to Harvard University for graduate work in economics because of his interest in understanding the causes of the Great Depression. After a stint at MIT during World War II, Exter joined the Board of Governors of the Federal Reserve System as an economist. In 1948, he served as an advisor to the Secretary of Finance of the Philippines and then to the Minister of Finance of Ceylon, now Sri Lanka, on the establishment of central banks. Between 1950 and 53, Exter was the founder governor of the Central Bank of Ceylon. In 1953, he became the division chief for the Middle East for the International Bank for Reconstruction and Development. In 1954, Federal Reserve Bank of New York appointed him as vice president in charge of international banking and precious metals operations. Exter left the New York Fed in 1959 to join First National Citibank, then the world's second largest bank, as a vice president. The next year, he was promoted to senior vice president as an international monetary advisor for the bank's international banking group. He had special responsibilities for relations with foreign central banks and governments. In 1972, he took early retirement to become a private consultant. Exter was a member of the Council on Foreign Relations, the Committee for Monetary Research and Education, and the Mont Pelerin Society, that's in Switzerland, and the Pilgrims of the United States. Some people think the Pilgrims are very influential and are basically the club that runs the Anglo-American empire, so to speak. So this guy is no conspiracy theorist. He was way up there. He was part of the club. But after he retired, he started writing the truth, in my opinion. And that's why I've always listened to John Exter and what he had to say. So let's go through John Exter's speech or presentation to the American Institute for Economic Research. Currencies today are IOU Nothings. Now that the international monetary system we have so long known has broken down, the world is groping through monetary reform for a new one. It is time to consider some fundamentals. What is money anyway? First, it is a means of payment or medium of exchange. I prefer that first phrase. It is simpler. We all use money to pay our bills, to buy goods and services. We also accept money when we sell. Second, it is a standard of value. We quote values of goods and services in terms of it. The resulting ratios are prices. Third, it is a store of value. We hope to avoid loss by holding it. Money holds its value if it is scarce and remains scarce. Scarcity is the keystone of store of value money. Today, no money in the world fully performs all three services. National currencies are being used as means of payment and standard of value money, but none in this inflationary age is an assured store of value money. In fact, a foremost concern to voters and politicians everywhere is that so many currencies are so rapidly losing their value in terms of commodities and services. Commodities like gold and silver, which are being used as store of value money, are not being used as either means of payment or standard of value money. Well, you can do it yourself. You can be on a gold standard or a silver standard. I think in 1972, Americans weren't allowed yet to own gold. Well, they had ways to do it, but not everyone knew how to do it. Thus, the world we have so long known, in which most currencies are redeemable at a fixed price in a store of value money like gold, is in disarray, and I would say has been in disarray since 1972 or 1971. People are confused and wondering what money they can trust. Sensing the instability of the system as a whole, they turn day by day from one means of payment money to another in the foreign exchange markets, and much more gradually to store of value money like gold in the London and Zurich gold markets. So there you go. He's actually telling us that people are confused, and they're going from one means of payment, currency or money, to another one in the foreign exchange market. And that's why I keep telling you, don't be distracted by the relative moves amongst fiat currencies, because they're all IOU nothings. Scarce commodity. If we carefully look into the meaning of this market churning, it becomes clear that store of value money, if it is to endure, must be a commodity, and a scarce commodity too. Silver has long been a less satisfactory store of value money than gold, principally because it has been and promises to continue to be more abundant. Many of the currencies used as a means of payment and standard of value money have not proved good store of value money, chiefly because they too have grown too abundant. Since they are simply either paper currency notes or bookkeeping deposits promised to pay, i.e. debt obligations or IOUs, the confidence of people in them as store of value money depends heavily upon the ability of the central banks responsible for the issuance to honor those promises to pay in a commodity that is indeed store of value money. So that's completely gone out the window. Central banks only promise to pay now with more and more debt and IOU nothings. So it's a Ponzi scheme, people. It's a Ponzi scheme right now. This is the issue of convertibility, which the Europeans, especially the French, are emphasizing today. Well, they didn't get the convertibility, did they? And 50 years later, almost, since he gave this presentation, we're still getting IOU nothings. And that's why you need to be really trying to get out of this system if you have stored a lot of your value into this IOU nothing currency. Until March 1968, when the two-tier gold system was established, the central banks issuing all major currencies were promising all holders IOU gold at $35 an ounce. Under the two-tier system, however, the IOU gold promise was abrogated for private people, and except for the South African Reserve Bank, central banks refused to sell any gold at any price to private people. The IOU gold at $35 an ounce promise was honored only among central banks and governments, and even among them it became gradually more tenuous. On August 15th, 1971, the IOU gold promise was abrogated even among central banks. Some relative rates. So today, all currencies in the world are saying, I do not owe anybody anything. Each one says, in effect, I owe you nothing in the way of any commodity that is a store of value money. In that situation, an attempt was made at the Smithsonian to reestablish fixed exchange rates, which meant making one central bank's IOU Nothings equal to a certain number of another central bank's IOU Nothings, with a 2.25% spread on either side of parity. It is obvious that such an arrangement could last only if the exchange rates agreed on at the time were equilibrium rates, and if in future all central banks agreed to control the issue of their new IOU Nothings at the same relative rates. The second condition was certainly not met, and no one can be sure the first one was. So that's why gold and silver are so important. That's why the central banks try to control the price of gold and silver, because the lower their currencies drop versus gold and silver, or the higher the price of gold and silver goes versus those IOU Nothing currencies, the more people realize that it's a Ponzi scheme. So now you kind of understand why gold is such a manipulated and controlled market. But they won't succeed because if they succeeded in controlling the price of gold, we'd still be at $35 an ounce, but we're at $1,700, right? Although it was agreed to raise the price of store value money, gold, to $38 an ounce, no arrangement was made for a central bank that went into deficit because it issued too many IOU Nothings to pay a surplus central bank in gold at a fixed price. Meanwhile, the gold owned by central banks remains for the most part buried inactive in their vaults. Gresham's law has worked. Bad money has driven good money out of circulation. Even among central banks, all currencies are inconvertible into gold. We are in a world of irredeemable paper money, or paper currency, really. Further conclusions follow from this analysis. Good store of value money is clearly the strongest kind of money. IOU Nothing money, which people may continue to hold as a store of value for a long time, but only with the enticement of ever higher rates of interest, may continue also for a long time to serve as a means of payment and standard of value. But as it becomes more abundant, it will serve these functions less and less satisfactorily. If too abundant, not at all. So that's where we are right now. In my opinion, it's clearly becoming too abundant. And that's reflected in the increase in the balance sheets and the money supply. M2, balance sheets of the central banks. And they're not even offering a high interest rate anymore. They're offering you zero. Sometimes they're making you receive negative rates, which means you're paying them to get this rubbish currency, IOU Nothing currency. It's totally crazy. It's the biggest economic delusion in all history, I would say. It would then also cease being held as a store of value, not worth a continental. History is full of examples of IOU Nothing currencies that have disappeared. Some currencies will, of course, become overabundant faster than others. Over time, it is scarce store of value money like gold that endures. If enduring store of value money must be a commodity, it follows that governments and central banks cannot create it, unless they were to go, let's say, into the gold mining business. It follows also that if they persist in creating IOU Nothing money, they will slowly but surely run themselves out of the money-making business altogether and have to start over again. I think we are pretty much near that juncture. I hope they won't start over again. I hope the market takes over. So it is also apparent and at the same time reassuring that it is private people in the marketplace, not governments, who decide what money is and what different kinds of money they are going to use and hold. especially the enduring store of value money, the most important of all. I think it's quite interesting that a guy who was quite well connected to the elites, was a central banker, thought that it was people, private people in the marketplace and not governments who decide what money is. So maybe he had an epiphany and he realized that the people he worked for were no good. And maybe he's the opposite of Greenspan. Greenspan started out thinking like John Exter thought at the end, and then he went the other way, Greenspan. So he's kind of the opposite of Greenspan, I would say. So let's continue. Gresham's law. Governments will always try to shore up IOU nothing money with laws making it legal tender, or even laws prohibiting the holding of store value money like gold. But such laws cannot for very long add value to something that is losing value in the marketplace. Gresham's law, which is really a special form of the law of supply and demand, will override man-made laws. In fact, there would be no Gresham's law if governments did not persistently try by man-made laws to overvalue their IOU nothing money in terms of store value money. Thus, law prohibiting people from holding store value money like gold cannot succeed, for gold as a commodity can be held in countless forms and readily converted from one form to another. People will hold jewelry or old coins or what have you, and people whose governments permit them to hold gold will do so in any form. The other story about John Exter is that in the 60s he was buying a lot of gold because he knew what was going to happen, and he was in the States, and the way he went around it is through buying old gold sovereigns. They were considered numismatic. It should also be apparent that monetary theorists cannot arbitrarily decide what money is. Theories that are based on an arbitrary definition of the stock of money, particularly IOU nothing money, will slowly lose their relevance. Such theories try to overvalue IOU nothing money just as governments do, and in the marketplace, Gresham's law will override man-made theories just as it overrides man-made laws. So it also follows that governments cannot reduce the importance of a store of value money like gold in the monetary system, much less demonetize it. A monetary authority monetizes anything by buying it and taking it into its balance sheet as an asset and paying for it by creating or issuing monetary liabilities, now IOU nothings, which are accepted by the seller. That's what I was talking about earlier, how the Federal Reserve creates fiat currency or fiat money. It demonetizes anything by selling it from its assets and extinguishing an equivalent amount of its liabilities tendered to it by the buyer. So here's the interesting part. Obviously inflationary. To demonetize gold, the central banks of the world would have to sell all their holdings in the open market. If they were to try, the exercise would be very deflationary, for they would be extinguishing their monetary liabilities with every sale. To avoid the risk of deflation in today's monetary world, they would simultaneously have to monetize IOU nothings like government securities by creating new IOU nothings of their own more rapidly than they extinguished the old by demonetizing gold. Such an exercise would obviously be inflationary, and central bank IOU nothings would steadily lose value in the marketplace. Under Gresham's law, the bad IOU nothing money would drive the gold store value money out of circulation. But if the central banks persisted, and there would be precious few restraints to stop them, their IOU nothings would slowly lose value, and under runaway conditions, all value in the marketplace. Thus, over time, the marketplace would frustrate central banks if they tried altogether to demonetize gold. It would demonetize their IOU nothing money instead. So they're not likely to try, and he was right. Central banks still hold about 35,000 tons of gold. It is not even likely that one central bank would try. Others would welcome the opportunity to monetize the gold that it sold, and at the same time to demonetize some of their IOU nothings. In recent years, there has been an attempt to substitute so-called paper gold or special drawing rights. So that's what he called special drawing rights, paper gold, in the International Monetary Fund for real gold. One high IMF official is even reported to have called gold metallic SDRs. If used seriously, such an appellation flies in the face of marketplace assessment of a store of value money. I've always said that SDR is like paper. The SDR has no obliger, no promise to pay any store of value money at a fixed price, and no fixed maturity date other than a complicated reconstitution provision. It cannot be sold at will, only by central banks in deficit, and only to central banks strong enough to be designated by the IMF to receive them. So it is who owes you nothing and when. That's the SDR, who owes you nothing and when. And it does not even pay a market rate of interest, only 1.5%. Well, you'd be surprised now at where interest rates are. If central banks ever monetize them in significant amounts, they will have moved from days when they issued their IOUs principally to buy enduring store of value money like gold, to these days when they issued their IOU nothings principally to buy government IOU nothings, 2 days when they would issue IOU nothings to buy who owes you nothings. In days to come, international monetary reformers will have to consider whether these new kinds of money will produce a stable monetary world. In the world's marketplaces, will they hold their value against goods and services in general? More particularly, will those issued by different central banks hold their value against one another? Most particularly, will any of them hold their value against store of value money like gold? They didn't, Mr. Exter. Gold's gone to 1,700 now, and it's even been up to almost 2,000 a few years ago. And I think it will continue to be the store of value money in the future. And that's why you need to hold on to gold and silver as well, I would say. I know this has gone on for a long time, but I think it's really important that people understand the system, especially coming from an insider who was so knowledgeable about central banking and money. So if you enjoyed this video, please hit the like button. Make sure you share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.